Experiencing an investment loss is never an enjoyable experience, but we understand as long-term investors that sometimes we may need to take a step back before we take steps forward. Over the long term, we expect our investments to grow. But in the short term, there may be some unpredictable volatility that we simply need to grit our teeth through at certain times. Now, a mistake that I see a lot of retirees make is during these market downturns, when they're experiencing an investment losses, they just simply sit on their hands and don't want to make any changes because at the end of the day, making a change may have an irreversible negative consequence. And during times of market volatility, it can be very nerve-wracking to make any specific changes for that exact reason. Now, here at Safeguard Wealth Management, we're of the belief that during every market cycle, there represents an opportunity that you can take advantage of for you to move your retirement forward in the right direction. And so in this video today, we're going to talk about how you can take an investment loss and turn it into a taxable gain for your situation. Now, I'm not talking about making some risky investment move in order to try to beat the market. I'm talking about using the IRS code, using the IRS tax tables to your advantage to improve your situation and capture a tax gain from these investment losses. Now, let's go ahead and get into it. But to explain this tax strategy, we're going to go back in time to the last time that we saw some pretty significant market volatility, back to the COVID crash of 2020. Now, on the screen right now, we can see that being an investor in this Vanguard Growth ETF, that the max drawdown from the peak to the bottom value is around 32%. Now, during these investment losses, there may not be some strategy that we can implement in order to turn this loss into an investment gain, but we can turn this investment loss into a tax gain. And we can do this by using something that we call tax bucket arbitrage. So when we think about your different retirement accounts, from a traditional IRA account to a taxable account to a Roth IRA, each of those accounts have a different tax status for our retirement. For instance, when we withdraw from traditional IRAs, that is taxed at ordinary income rates. You can see on the left-hand side of this table, married filing jointly ordinary income rates for 2022. Now, our taxable account, if we're holding investments in that account for more than a year, they are subject to something called long-term capital gain rates. You'll see this table on the right-hand side of the screen here for long-term capital gain rates for a married couple. Now, the goal of tax bucket arbitrage is using these two different tax tables to our advantage. Essentially, what we want to do is we want to deduct or offset income at high ordinary income rates and then recapture that same income, that same taxable event at more preferred rates, long-term capital gain rates. And this is exactly what this strategy in this video does. And so let's look at what this might look like in practice. We're going to use a retiree named Jerry. Now, Jerry is still working, and as a Christmas bonus, he received a $10,000 bonus from his work. He then invested that bonus within his taxable account, and in January of 2020, he bought VUG, which is the Vanguard Growth ETF that we just previously showed in that last chart. He experienced an investment loss like what we see on the screen right now. So he bought into VUG somewhere over here in January. In the preceding months, as the COVID pandemic rocked the markets, he was at a pretty significant loss. And so is there anything that Jerry can do to take this investment loss and improve his retirement without having a ton of risk, without making a significant investment change that might turn out poorly? Well, the answer is yes. So what Jerry can do is Jerry can sell VUG. He can sell out of that Vanguard Growth ETF. Now, he is at a 25% loss from his initial starting price. So that $10,000 that he previously had turned into $7,500. And so Jerry sells out of VUG, thus capturing an investment loss. Now, this is a short-term capital loss because he's held this investment for less than a year. If he's held it for more than a year, it would be a long-term loss. Now, because he's lost 25% on his initial $10,000 investment, he's at a $2,500 loss. Now, Jerry is in the 22% income tax bracket. And so this $2,500 short-term loss at the end of the year is going to offset his income. It's going to essentially lower his income by $2,500 because he's able to take this deduction for this capital loss. And if we're offsetting income at a 22% rate, but wait a second, if Jerry just sold out of this investment when it was at a loss, sure, he did capture that tax loss that offset his income, but now as the market recovers, he won't experience any of that recovery. So as the market recovers, yes, he did gain a $550 tax gain within that given year, but as the market recovers, he's essentially locked in that $2,500 loss. That doesn't seem like it makes a ton of sense. Well, stick with me here. Jerry is going to capture this investment loss, and then he's going to reinvest in a relatively similar security. So what might this look like? Well, Jerry's going to sell out of VUG. This is a Vanguard Growth ETF that seeks to track the performance of the CRSP U.S. Large Cap Growth Index. This is at an expense ratio of 0.04%, and the Vanguard Growth ETF is a very large growth ETF. It has over $165 billion in assets. And so instead what he's going to do is he's going to then buy a similar ETF, something like the Schwab Large Cap Growth ETF. These are both large cap growth ETFs that are meant to follow an index. Now the Schwab Growth ETF seeks to track the performance of the Dow Jones US Large Cap Growth Total Stock Market Index. It's at a very similar expense ratio and is also a very large ETF. Now, why would he change out these given investments? Well, he's capturing that tax loss and then investing in a very similar ETF that is different enough in the eyes of the IRS. Now, in order to use this strategy, the IRS demands that you invest in something that is not substantially similar. And in the eyes of the IRS, this would not be substantially similar. Here's why. We are switching out a Vanguard Growth ETF for a Schwab Growth ETF. So there are different investment companies at the first look. Secondly, they track slightly different indexes. Now, these indexes may perform very similarly, but nonetheless, they are different indexes. And so again, in the eyes of the IRS, these are substantially different enough. But what about in reality? Well, when we track the performance of these two given ETFs, you'll notice that they track very closely. You generally look at this in terms of something called correlation. The higher the correlation, and a score of 1 would be the highest correlation, the higher the correlation, the closer these two will track. Now, as we look at the monthly correlations between VUG and SCHG, we notice they're at a 99% correlation. And this is intuitive as well when we look at the chart mapping the performance of these two ETFs. From 2010 to 2022, these two lines are almost indistinguishable. They track very closely. And so what Jerry is going to do is he's going to sell out of VUG and capture that tax gain, offsetting his tax bill at 22%. On the same day, he's going to then take the same amount, that's $7,500, and buy into SCHG. Then over the subsequent year, obviously the stock market recovered. In hindsight, we know this. In fact, over that subsequent year, not only did large cap growth recover from that given drawdown, but by the end of the year, it was at a new high. Now, for simplicity and not to muddy the waters with additional variables, let's just say that large cap growth just recovered back to break even 1 year later. Now, because of holding that given investment, SCHG, for 1 year, it would now be classified as long-term capital gains. So basically what Jerry did is he took a taxable loss and offset that at ordinary income rates. Now when he recaptures that same gain, the loss that he had previously offset, he's going to recapture that gain, but it's now going to be taxed at those preferred long-term capital gain rates. He offset his tax bill by $550, but when he recaptured that same taxable event, he recaptured it at only a tax bill of $375. So he had a tax gain of $175. Now, over this 1 year time period on this $10,000 initial investment, this tax gain is 1.75% of added return that he thus captured for his retirement. Now, did he take any greater risk in order to do so? No, well, not if he did this properly. He sold out of a large cap growth ETF and then bought a very similar, very highly correlated Vanguard growth ETF from another company that tracks a slightly different index. But again, they are highly correlated together. So he sold out of that investment, captured a tax gain, and then reinvested the same exact day and was able to experience that full recovery. Now, the big disclaimer here is this is assuming that he performed this strategy properly. Now, in the previous example, we looked at Jerry offsetting his income at a 22% rate and then recapturing that income at a 15% long-term capital gain rate. But what happens if he retires at the end of 2020 in the midst of this given tax strategy? And so he offset his income while working at a 22% rate, thus receiving a $550 tax gain. But then when he recaptures that later in retirement, he's at a lower income. And thus he's able to capture that long-term capital gain at the ever elusive 0% long-term capital gain rate. And so now he still has that same $2,500 long-term capital gain, but now he owes nothing in terms of the tax bill. And so now that tax gain of $550 on that $10,000 investment translates to a 5.5% tax gain. And so the larger the rate that we are offsetting income at versus what we are later recapturing that same income at, the larger the gap between those two rates, the larger benefit that you will gain from this type of strategy, from something called tax loss harvesting. Now, no one aims to incur investment losses, but again, this is part of investing. Now, with strategic tax planning, we can turn those investment losses into a tax gain as we just showed. Now, certain robo-advisors like Betterment or Wealthfront have done a lot of research on this concept of tax loss harvesting. Now, through their research, they estimate that the average investor can gain somewhere around 0.5% to as much as 1% on an ongoing basis in terms of adding tax loss harvesting as an overlay on your taxable account. Now, it's important to know the details that can mess up this given strategy. So first, be aware of the offsetting rules. So in our taxable account, when we're thus incurring either tax gains or tax losses, those will first be offset. The losses will offset the gains. So let's say in a given year, we have $1,000 of short-term capital gains. We then have $500 of short-term capital losses. Well, those will offset each other, and at the end of the year, that retiree will have a $500 short-term gain. And so they'll offset one another first. After the offsetting of gains and losses, if you still have a capital loss, the next step would be taking that loss and offsetting income. Now you can do this up to a specific limit, $3,000 in any given year. You can then carry forward a $3,000 loss if you still have remaining losses. So what might that look like? Let's say that you have $3,000 in taxable gains in that given year and you have $7,000 in taxable losses. So in that given year, you can take that additional $4,000 of capital losses and you can offset your income by $3,000. From there, you can also carry forward that additional $1,000 capital loss that you weren't able to capture moving forward into that following year. And again, each and every year, you can take $3,000 of previous or current capital losses against your income. But here's the very important thing that you need to be aware of when performing any tax loss harvesting. You need to be aware of the tax loss harvesting mistakes that are relatively easy to make. A big one is something called wash sales. Now, the IRS set up this wash sale rule in order to prevent retirees and investors from abusing this tax loss harvesting idea. Now, this wash sale rule specifies that if you buy an investment and sell it within 30 days at a capital loss, or you sell an investment and then rebuy that same investment or a substantially similar investment within 30 days after taking that tax loss, you will essentially reverse all of the benefits of that tax loss harvest. Let's say that Jerry sold out of VUG and then 10 days later bought back into VUG, or maybe sold out of VUG and the same day bought right back into VUG. Again, this would break the wash sale rules because it's within 30 days he bought the same security. Let's look at another scenario. Let's say that Jerry sold out of VUG, took that tax loss, and then bought back into VUG in, let's say, his traditional IRA within that 30-day time period. Well, again, this would break the wash sale rules because essentially what Jerry did is he took that tax loss and then he reinvested back in the same security, just in a different account. The IRS doesn't want that. That is breaking the wash sale rules, and it will reverse all of the benefits of tax loss harvesting. And so there are a few things that if you do, you will break this wash sale rule. So if you break that 30-day rule that we just discussed, if you or your spouse buys the same or substantially similar security in the eyes of the IRS, again, that will break this wash sale rule. And then if you or your spouse invest in the same or similar security in a different account, a retirement account, again, you don't have that protection just because it's a taxable account versus a traditional IRA. The IRS is going to look at your entire situation and if you broke that wash sale rule, and that would be counted as breaking that wash sale rule. And so this video really shows how you can turn an investment loss into a positive thing for your retirement, turn it into a tax gain using tax loss harvesting. But as you use this strategy, make sure you're using experienced help to make sure that you're not breaking some of those wash sale rules and thus reversing all of the benefit that you gain from tax loss harvesting. But this video really proves the point that during every market cycle, there are things that you can do to take advantage of those market cycles. During market downturns, the strategies that you can use to improve your retirement from here are typically tax strategies. Now, we talked about one of those tax strategies in this video today, tax loss harvesting. But there is another tax strategy that you can use during investment losses that I'll link to right here that talks about using Roth conversions during these market downturns in order to improve the benefit of that Roth conversion. This is a powerful tax strategy that you don't want to miss out on the window of opportunity that's available for your retirement. Now, thanks for watching this video. Thanks for taking the time out of your day to improve your retirement. We look forward to seeing you in the next video.